So, Julie Mayer is the owner of the retail store 151 Jeans. She purchases jeans from a number of manufacturers to bring great style and fit to her customers. Prepare journal entries for March 2017 and record the following transactions. Assume a perpetual inventory system. So on March 2nd, we purchased jeans from Page Denim under the following terms. So they offered us, because we're purchasing, $215, net $60, freight on board, shipping point. So what does this mean?
We're paying the shipping.
Yeah, we're going to pay the shipping because we take ownership when it leaves their warehouse. We have to pay within 60 days, which is pretty generous. And we can get a 2% discount if we pay within 15. And because they offer us terms, what does that tell us about how we're going to be paying?
Credits payable.
Yeah, exactly. So first thing we can do is we can debit our merchandise inventory, and we can credit our accounts payable for the amount of Now, every cost involved with getting your merchandise inventory on the shelf ready for sale, so the cost of shipping, the cost of insurance, if you have to warehouse it off-site, and the cost of the warehousing, the cost of painting it or prepping it, whatever the cost between buying it to having it ready to be sold, you have to actually include, will increase, even though it is, it seems like an expense, it will actually increase merchandise inventory, the asset balance. You expense it when it is sold as a cost of goods sold. So in this case, paid $350 for shipping charges for the purchase on March 2nd. This will not be shipping expenses. When we sell, it's different. But when we buy, any cost involved in perpetual inventory increases the current asset merchandise inventory. When you get to cost accounting next year, you'll end up learning about the different ways to cost these things out and the different tools that are used. But for now, we know that we can just, in this case, when we sell things, it'll just tell us our cost. Next year, you'll learn how to actually cost it. So we know that this is merchandise inventory for $350. So our asset is going up, and our cash is going down. So we returned to Page Denim unacceptable merchandise that had an invoice price of $400. So what do we need to debit and credit?
Debit the account payable.
We're going to debit our account payable. So we owe $400 less. And what do we have less of now? Inventory. So we can adjust our merchandise inventory. Record. Sent a check to Page Denim for the March 2nd purchase. Net the returned merchandise and applicable discount. So this little section here, this is pretty nice of them to tell us that, or to remind us about that. You probably won't get that on the exam. So just make sure you're aware of if terms are offered. So in this case, they're telling us, yes, we took advantage of the terms. So this is on the 17th. So what are we going to debit? Accounts payable. And it's 4,200 less 400. So for 3,800, because now we owe them 0. And how much cash are we sending them? What is the check value for?
4,200?
No, so it's going to be 3,800 less, or 2%. Right, what is 98% of 3,800? 3724. So every expense that you incur to get your inventory ready for sale increases the value of your inventory. So every refund or discount you get on the same merit should do what to your inventory? Decrease it. So we can adjust our merchandise inventory down the amount of the discount. On the 18th, purchased jeans from J Brand under the following terms: $9,600 invoice price, $210 net 30, FOB destination. So when we purchase inventory, what are we going to debit? And now they offer terms. So how are we going to pay? Credit. So what do we debit? Merchandise inventory, right? Because we're purchasing inventory, so our inventory is going to go up. 9,600. And what will we debit? Accounts payable. After brief negotiations, we received J Brand a $2,100 allowance on the purchase of March 18th. So J Brand decided to take $2,100 off of our bill for whatever reason. So we can reverse $2,100. We owe them $2,100 less, and our merchandise inventory is valued $2,100 less. Sent a check to J Brand paying for the March 18th purchase, net the discount and the allowance. So on the 28th, we're going to pay the bill. So what are we going to debit?
$7,500?
For what account?
Oh, their accounts payable.
So we debit their accounts payable for the 7,500 to balance the account. How much money are we going to send them? What will the check be written for? They took advantage of a 2% discount, right?
6,850.
2%, so 98% of 7,500 is what we'll send them.
73.50.
And then what will be where will we make the difference up?
Merchant inventory.
Yeah, we're going to decrease our value of our merchandise inventory.
So that word allowance